And in fact, according to Credit Suisse, a recession usually does occur on average 22 months following such an inversion. And often the S&P is actually higher 1 year after an inversion. So now that this warning signal has been flashed once again, what happens next? We're joined tonight by Kathy Jones. She's Chief Fixed Income Strategist at Charles Schwab. Kathy, it's always good to see you. Thank you for joining us tonight.
Thanks for having me, Bill.
Janet Yellen said today that it's possible that this was a false signal by the bond market. What do you think?
Well, there have been instances where we've had the yield curve invert in the past and it hasn't led to recession. So there have been a few false signals. I think what she was referring to was the fact that in this particular case, the reason short-term rates are above long-term rates is that long-term rates are falling, rather than the reason being that rates are rising and the Federal Reserve is tightening policy and by raising short-term rates. So because it's being led by the longer-term rates, she may be implying that this may not be consistent with the past.
So what could change the situation? Because this inversion came, as Bob mentioned earlier, against weak global growth. The numbers out of Germany were bad. The numbers out of China were bad, which complicates the situation, does it not?
No, absolutely. I think the falling long-term yields in the United States and all around the world are reflecting that slowdown in global growth and that fear of a global recession compounded by the trade situation. So I think the risk of recession certainly is rising for those reasons. I think what happens next is we probably will see the Federal Reserve lower short-term interest rates to try to offset some of the impact of the slowdown in the global economy.
And of course, the $64 question, what does the individual investor do with all of this right now?
Well, first things first is if you're an investor, take a deep breath, take a look at what you own, and are you comfortable with where you are in terms of the risk that you're taking? And do you need your money in the next, 1 to 2 years? So if you do, that money should be in a safe place like a CD or a treasury bill. And if you've got that tucked away and the rest of your money is for a long-term horizon, then you may be okay. But if it's uncomfortable, you might want to rebalance. You might want to move into less volatile securities, have more bonds than stocks. It's really all about having kind of a financial plan laid out where you can ride the ups and downs of the market. But you have to have the capacity to do that, to take the risks.
Kathy Jones with Charles Schwab again. Thank you for joining us tonight, Kathy.
Thank you.